Hi, good morning, everyone. Welcome to our Phillip Securities Research morning call for today. We have quite a few stock counter updates, as well as Phillip on the ground on Seatrium, some technical analysis, and also some macro and sector outlook on US Power 5 and the Singapore weekly. So without further ado, I'll hand over time to Jonathan to get started on the Phillip US Power 5. Thanks.
Yeah, thanks, Zane, and good morning, everyone. Yeah, so I'll just start with our US Power 5, or at least an overview of the S&P 500 performance in July. Overall, we saw this kind of rotation out of tech and into some interest rate sensitive uh, sectors such as real estate and utilities. You see the red boxes here. Tech was down 3.3%. Communications was flat. Communications incorporates companies like Google and Netflix and so on. And then you see such significant gains in real estate and utilities, up about 7% for the month. At the same time, we also saw a little bit of rotation into some of the cyclicals like materials, financial, as well as industrials. They're up 4 to 6%, far outperforming the S&P 500. But overall, most of the month was dragged down by tech. You can see significant weightage on tech stocks in the S&P. When you look at the individual companies, top gainers and losers, the biggest one to note here would be 40% loss in CrowdStrike. Although not quite the largest loser for July, it was still a significant downturn, mainly due to their software outage that caused Microsoft 365 and a lot of products to crash. Yeah, next slide, please. Yeah, when we take a look at our Power 5, essentially it's just 5 companies that we have coverage on. You can see over there, it's mainly your 3 hyperscalers plus NVIDIA and JP Morgan. For the month, it was its worst month so far this year, down about 5% compared to the S&P. It was up 1.1%. Overall, year to date, it's still up 40%, outperforming the S&P by about 25%. So still significant gains. Obviously, most of this is driven by NVIDIA. See 136% year to date as of 31st July. Yeah, so that's all for our Power 5. We didn't make any. We introduced this only in June, so we haven't made any changes so far. Yeah, next slide, please. Yeah, okay, so with that, I'll start with AMD's second quarter results that they issued last week. We issued a report titled AI is still the key driver. The key things for AMD, revenue was in line, while PATMI actually missed a little bit because of higher R&D spend. Yeah, first half revenue at PATMI was at 44% and 12% of our forecast. Although we do expect a significantly more backloaded second half of this year, especially in terms of PATMI, mainly due to the ramp of its AI GPU, its MI300X AI GPU. In terms of the positives, data center revenue continues to accelerate. So data center is both a combination of their AI GPU as well as their traditional server. Currently, most of it is still actually from server CPU. When you look at 2.8 billion, about 1 billion is only about 1 billion is from their AI GPUs. The other 1.8 billion is from traditional server CPUs. So the good thing here is that they're continuing to ramp their MI300X, which essentially is the comparables to NVIDIA's H100. So essentially, and the thing about AMD is that they essentially 1 year ago, this number was 0. They actually just started producing their AI GPU, so they're seeing quite significant ramp for this product. Quarter on quarter, it implies about 400 million to 500 million US dollars of increase. That's just how much supply they're able to acquire from TSMC. You compare this to NVIDIA is doing about 3 to 4 billion, so it's still quite far away. But at least they are still able to increase their ramp and increase their sales that way. Like I said, traditional server CPUs is also seeing pretty strong growth. We estimate roughly about 25 to 30% year on year, especially as a lot of customers continue migrating. A lot of enterprises continue migrating from on-premise to off-premise on the cloud. They're starting they're starting to generate a little bit more demand for their AMD's traditional server CPU products, especially their EPYC, and they call it EPYC, which is their CPUs. Yeah, like the key highlights, key customers that they managed to gain this quarter were actually Netflix and Uber that came on board as their server CPUs. Um, Another positive is that like Nvidia, they announced annual product rollout. So this is actually biannually, so once every 2 years, but they increased it a little bit for several reasons. Firstly, is mainly to keep up with the competitor. And secondly, is also another way to try to capture as much AI GPU sales as possible, at least in the near term, especially with demand so high. So the new AI accelerators, which will be the MI 350 and then 400 and 500, they'll have the same infrastructure as the it's supposed to be MI 300X. So essentially, what this means is that for customers that want to buy the newer variances and newer accelerators, they would have essentially no issues adapting this to the older infrastructure. So it's more of a plug and play rather than having to build out new infrastructure. Would be both costly as well as time. Will take some time. So positive there. The last positive is guidance for this upcoming quarter that we're in implies accelerating year-on-year growth, which is quite expected because um, growth for the last couple of quarters haven't really been that significant in the first place. I believe the first quarter growth was like 2 or 3%, and now you're seeing this ramp up to 9% and then 16% in this upcoming quarter. Most of it will be driven by AI GPUs. While at the same time, client, which is their PC revenue, is also starting to show a little bit of promise. AMD mentioned that they're expecting above typical seasonality for its PCs in the upcoming quarter, especially due to this um, upcoming or current enterprise refresh cycle that we're in, as well as a little bit of upside from AI PCs. I mean, the negative, like the last few quarters, is gaming and better remain quite weak. You can see here, gaming is down almost 60%. When I mean gaming, a lot of it is semi-custom chips, that are inside your Xbox or your PS5s. And the biggest reason for this is because, we're quite late in the cycle. I think it's the fifth or sixth year after launching those new products. So naturally, sales has come down quite significantly. Demand is down quite a bit. Yeah. So the expectation for this is still to remain quite weak, at least until the next new console will be launched. I think they expect probably second half of next year. Um, yeah. So in terms of outlook, we're still quite positive about AMD. Obviously, the MI 300X RAM will the biggest near-term revenue and revenue driver as well as margin expansion, because it is just higher margin versus the rest of its other products. Obviously, the accelerating product cadence is positive to keep, at the very least, keep up with its competitors and try to gain market share from them. In terms of valuations, we maintain a buy, but we actually lower our target price to $180, because we reduce our PATMI by 15%, mainly due to an increased R&D expenses, especially as the company fast forwards its product rollout. Right, naturally you see a little bit more intense R&D expenditure over there. Yeah, so overall we're still quite bullish on AMD. We have a buy rating on it. Next slide, please. I'll move on to Google next. They also announced their earnings a couple of weeks ago. They issued a report titled "Extending AI Leadership." So for Alphabet, or rather for Google, very good set of results. Second quarter revenue was within expectations, while PATMI was above due to higher operating leverage. You can see here, revenue is growing about 14%, and then operating income is up 26%, so it's almost double. First half, 2024 revenue and PATMI came in at 48% and 51% of our forecast. The main positives for Alphabet is advertising is still remains fairly resilient. Their search advertising revenue grew 14%, while YouTube advertising grew 13% year-on-year. So they're starting to see, one of the biggest reasons for this is because the consumers are still fairly resilient in terms of their spending, and therefore advertisers are still willing to advertise and put money to try and capture this spending, particularly in the US. We've seen quite a lot of increased spending coming from APEC region, especially from China, as they try to capture a lot of the outbound dollar spending. So they're advertising a lot more in the US, trying to get the dollars to at least the US consumer to purchase some of their items or some of their products. In terms of how Alphabet uses AI, AI remains a key differentiator for them, especially in the cloud. They continue to see significant demand for its AI infrastructure as well as some of its generative AI solutions that it has launched on its own Google Cloud and Google Workspace. So you're seeing a lot more demand from some of these customers, and because of this, they're able to raise prices. So the average dollar per seat has actually increased as well, and that's benefiting cloud. You can see here in the red box, they're up almost 30% year on year. A slight acceleration from the first quarter, which was 28% year on year. AI is also helping a lot of delivering a little bit higher ROI for advertisers, and that's also helping their core ads business. The last positive is margins continue to expand. You can see 32.4% operating margins for the second quarter. It's actually, I guess, slightly above its pandemic peak of 32.3%. And we would like to use pandemic peak because that's really the boomtown for a lot of digital advertising companies. Margins were the largest. Revenue growth was also the largest. The biggest reasons for this, like most other big tech companies, they're focusing quite heavily on maintaining their low cost base. At the same time, they're also starting to benefit a little bit from these leverage a little bit AI in terms of product workflows, and they're generating a little bit of efficiencies in that area. The main knock for Alphabet is their outlook. That's kind of why the stock took a hit after they announced it. The quarter outlook is a little bit soft on both revenue growth as well as margins. For the revenue growth portion, they don't give a specific number, but they did expect some moderation in growth, which is expected because of just generally how the where their revenue has come from. Like I mentioned earlier, they saw a huge surge in revenue especially from China in the second half of last year. So they're just lapping a period of higher base, and so growth will come down a bit, but the absolute dollar amount continues to climb. In terms of margins, they're going to be hit by increasing headcount, both on technical infrastructure side as well as they're going to be hiring a bunch of fresh grads, which they mentioned in the call. At the same time, they're also going to be hit by higher depreciation as they continue to increase their capex spending for AI-related both infrastructure, their data center, the servers, etc. In terms of our outlook for Google, we're still very positive on Google. They remain the main, I guess, almost a monopoly in the digital advertising space. AI continues to drive a lot of business growth in terms of ads as well as their cloud business. And we think that Google has the necessary talent as well as the necessary free cash flow to continue to maintain its AI leadership, continue to invest in this AI opportunity. Currently trading at what we view as very attractive valuations, 18 times 2025 earnings, well below its 10-year average, about 22 times. For our recommendation, we upgraded to a buy from accumulate. We also raised our target price from 195 to 205 US dollars, mainly because we raised our PATMI for this year on higher operating leverage by 4%. Next slide, please. For my last counter will be Meta Platforms. They also announced their results last week. Issued a report titled Better Than Expected Ad Strength. Next slide, please. The story for Meta is very similar to Alphabet. I mean, they're basically the two main guys in the digital advertising industry. So with a healthier industry overall, growth will continue to be quite steady. In terms of Meta, their second quarter results outperformed, both on the revenue as well as their margins. 39.1 billion in revenue was actually slightly above the top end of range of their guidance range. So they guided to their top end was 39 billion, so it's slightly exceeded. While net margins grew about 10 percentage points year on year. So they have a 35% net margin compared to 25% in the second quarter of last year. First half revenue and PATMI came in at 48% and 52% of our profit. So slightly above seasonality. Usually the back end or the second half of the year is more heavily weighted versus the first half in terms of result performance. So the main positives, the outperformance is mainly due to core ad strength. So similar to Google, e-commerce companies made up the largest contributor to ad revenue, at least for Meta. While they continue to see strong growth across a range of businesses, from your large businesses to small and medium enterprises as well. AI continues to also drive a lot of monetization opportunities. And how Meta does this is slightly different from Google. They have invested quite heavily in their new recommender system. So this is driving a lot of, I guess, more content viewership across users. while at the same time they're also optimizing some of the ad loads and placements especially for a lot of their short form video. So for Meta it'll be Instagram Reels or Facebook Reels. The main negative for Meta is that their Reality Labs segment or their metaverse business is still burning a lot of cash. So they had about 4.5 billion in operating losses for the quarter, and this is up 20% year on year. This is weighing about 12 percentage points on total operating margins. So if you take a look at the I guess in between the two boxes here on the left, the family of apps, which is their ad business, the operating margin is about 50%. And then if you add in the operating losses from Reality Labs, total operating margin comes out to 38%. So it's a significant knock there. Commentary on this is they expect more losses to continue, especially as they not really generating much revenue from it. The only thing they generate is like their Ray-Bans, augmented mixed reality or augmented reality glasses, and a few Quest 3 sales. Very minor. I think they only generated maybe 400 million in revenue. So it's quite insignificant compared to just their ad business. But actually they're going to continue investing in this segment because it's more long term. It's a more long term vision. So you expect to see more losses there and to weigh on margins a little bit. In terms of our outlook, they actually issued fairly optimistic guidance for the third quarter. Their revenue range of 38.5 to 41 billion implies a 16% year-on-year growth. So slight deceleration, which is also expected, similar to Google. But it was above consensus estimates by 2%. So that's kind of one of the bright spots for Meta. Similar to Google, we also think that Meta is still the leader in AI. We're also quite positive on its ability to leverage a lot of AI in its core advertising business, at least for some sustainable and quantifiable results. You can see this especially in when you see ad revenue continue to grow and prices continue to increase as well. In terms of valuations, we maintain and accumulate, but we raise our target price to $555 up from $510, mainly because we increase our revenue and PATMI estimates by 2% and 5% for 2024 on stronger ad revenue so far. So that's all for my comments. We hand it over to Ambrish to continue with Microsoft.
Thank you, John, and good morning, everyone. So moving on to Microsoft's fourth quarter results. So we issued a report last week with the title continued increase in the cloud spending. So overall, Microsoft's fourth quarter results, they were basically in line with the expectations, with its full year revenue and PATMI meeting our forecasts. So overall, it's in the fourth quarter, its revenue grew by about 15% year over year, and this was mainly led by a continued strength in its cloud service, which is Azure. So cloud Azure revenue, they grew by about 30% year over year, and this was mainly because of shift in workloads like SAP and Oracle from on-premise to cloud. And also it said that it's witnessing increased contribution for its AI related services, which basically helps enterprises to introduce features or generative AI tools like chatbots into their products. And secondly, the gaming segment, it continued to rebound with Xbox content and services revenue. It was up by about 61% year over year. And this was mainly because of the net impact from its acquisition, Blizzard acquisition, which it had acquired previous year. And so basically the gaming titles like Call of Duty, they were introduced on Xbox Game Pass streaming service, and this led to increase in the player engagement. In terms of negatives, the capital expenditures, they were slightly higher than expected, and it grew by about 55% year over year to $13.9 billion US. And most of this capex, it was towards the cloud and AI related infrastructure build out. So the company expects capex to increase sequentially in the first quarter of 2025, as well as for the whole of fiscal 2025 as compared to 2024. And this is mainly there's a negative sentiment towards this, mainly because the company, it has not yet disclosed any quantitative number or any revenue contribution from its generative AI tools like Copilot towards its contribution towards its top line growth. So as a result, there are still concerns over the increased capex. In terms of outlook for the first quarter of 2025, it expects a revenue growth rate of about 14% year over year, and this would be continued driven by Azure. Although it expects a slight moderation in its revenue growth rate to about 28 to 29%, and the moderation, it's mainly because it said that it's witnessing macro headwinds, and as a result, slowdown in spending, particularly in European regions, whereas its Office 365 revenue, it's expected to continue based on the company's estimates. So it basically implies that its operating margins is expected to contract to about 45%, mainly because of higher capital expenditures. Whereas in terms of valuations, we maintain our accumulated recommendation, whereas we increase our target price slightly to $480. And this is mainly because we reduced our FY25 revenue estimates by about 1%, mainly to reflect moderation in spending, cloud spending, as well as but we increase our PATMI estimates, and as a result, it increased by about 2% year over year, 2%. And this is mainly because we revised our estimates based on the company's guidance, and as a result, we lowered our operating expenses mainly because of high operating leverage. And as a result, our target price is raised to $480. So next slide, please. So moving on to PayPal's second quarter results. We issued a report last week where with the title, the company lifts its earnings guidance. So overall, the results, they were, the revenue, it was in line with the expectations, whereas the PATMI, it was slightly higher, mainly because of high operating leverage. So in terms of its performance, revenue grew by about 8% year over year. And this was mainly because of resilient cloud, resilient spending, consumer spending on its platforms like branded checkout and Braintree. So in terms of positives, the gross profit, it grew by about 8% year over year. And this was the fastest growth rate since 2021. And this was mainly because of the continued strength in its branded checkout, and also increasing contribution from its Braintree unit. So branded checkout, it's basically its legacy business, wherein the yellow PayPal button, wherein the consumers, they can purchase online or in store. Whereas it's a Braintree segment, it's basically, it had acquired that business in 2013, and it's basically a payment service provider. So it basically helps e-commerce companies to accept payments from customers like the companies like Uber and Airbnb. So moving on to the second positive, it's a non-transaction related operating expenses. They were down by about 1% year over year basis. And as a result, that has led to operating margin expansion of about 100 basis point to about 17%. And this was mainly because of it's a surge in its top line, as well as a high operating leverage. So basically, its sales and operating expenses, they grew by about just 3%, and it's also focusing in layoffs as well as real estate consolidation, and this is resulting in its operating margin expansion. Whereas in terms of negative for PayPal, its active number of active users, they dropped by about 2 million on a year-over-year basis. And this was mainly because of the management's efforts to reduce its lower quality customers, particularly in the Latin America and Asia Pacific regions. And however, despite this drop in its active users, the management highlighted that it's the number of transactions per active users, they grew by about 11% year over year. And this basically signals that suggests that it's the customer engagement, it has improved, although even if its number of active users, they drop. In terms of outlook for the full year, the company, it raised its gross profit outlook to now low to mid single digits from its previous slightly positive. And its gap earnings per share has also increased to about $3.93. And this is mainly because of the high operating leverage, and also company, it has been positive on consumer spending to remain resilient in the second half of 2024, mainly with the back to school and also upcoming holiday season. Whereas in terms of valuations, we upgrade to buy mainly to reflect the share price performance, and we slightly increase our target price to $80 from $75. And this was mainly because we increased our PATP by about 6% year over year, 6%, and this was mainly because of high operating leverage. So in terms of PayPal, we believe that it's well position to benefit from its two-sided network effects, wherein they have about 429 million active customers across 200 countries, and also it should benefit from a secular shift to digital payments. So overall, we have a buy recommendation and a target price of $80 on PayPal. So that's all for me. I would now like to pass it on to Glenn.
Thanks, Ambrish. Yeah. So for me, we have both UOB and OCBC results last week. So for UOB, next slide please. Yeah, they had their second quarter adjusted earnings meeting our estimates, as higher fee income as well as lower allowances were offset by lower than expected net interest income and other non-interest income. Their first half adjusted PATMI was at 49% of our FY24 forecast, and their interim dividend was up 44% year on year to 88 cents. So straight to the positives, the first positive being that their fee income rises from broad-based growth, so across multiple segments of their fees. So if you look at it, it's both their loan-related fees and wealth management fees, which rebounded, mainly from a recovery in lending activities as well as improved market sentiment. Their card fees similarly also grew, and this resulted in their fee income rising by 18% year on year to a near record level. If you're looking at their wealth assets under management, or AUM, it grew by 10% year on year from net new money inflows of 3 billion for the quarter. For the second positive is that their allowances and credit costs have improved. Credit costs have improved by 6 basis points year on year to 24 basis points, as their total allowances fell by 18% year on year, mainly from a decline in both their specific provisions as well as their general provisions. However, if you look at their new NPA formation, it has increased by 20% year on year. This is mainly due to one commercial real estate account in Hong Kong, but it is mentioned that this account is well collateralized and is not systemic in nature. And the only reason why it's actually an NPA is because they brought them to court, hence they have to place it into NPA. But UOB does seem to be very confident in being able to recover this account. For the negatives, the first negative is that their net interest income has continued to decline as their NIMs have softened. So NIMs fell by 7 basis points year on year to 2.05% as the deposit repricing outpaced the asset yield repricing. And this is offset slightly by loans growth of 3% year on year. Nonetheless, their interbank and securities margin has remained stable year on year from active management of their excess liquidity. However, on their quarter-on-quarter basis, the net interest margins did improve by 3 basis points, mainly from improved funding costs from the cuts made in their flagship one account interest rates, while average interest-bearing assets were stable quarter-on-quarter at 470 billion. And their loan margins have also improved quarter-on-quarter to 2.51%. For the second negative is that their other non-interest income was a drag to their earnings, and this mainly came from a lower swap gains as well as valuation on investments, which dragged down their other trading and investment income, which was offset slightly by a strong customer-related treasury income growth. As for the outlook, we do expect UOB's profits to continue to grow by 8% in FY24 on the back of stable margins, loans growth, recovery, as well as stronger fees and stable provisions. We also expect their credit costs to come in around the guidance of 25 basis points. As for the fee income, the UOB expects fee income to continue its recovery and for the growth to be led by credit card fees as well as their wealth and fund management fees as the market sentiment recovers. They have also integrated their city portfolios in Malaysia, Indonesia, and Thailand, with Vietnam to be completed soon in the second half of the year. And this could further expand their regional franchise with a larger deposit and customer base for them to continue to grow their sort of overseas market. As such, UOB has guided for double-digit fee income growth in FY24, which we believe could add around 220 million to their revenue. We do downgrade to an accumulate with an unchanged target price of $34.90, mainly due to us accounting for the recent share price performance. but our FY24 estimates remain unchanged. UOB will be able to maintain their current net interest income as well as net interest margins from cutting deposit costs as well as continuing to increase their loan margins. And other tailwinds for the bank include loan growth recovery from rate cuts in the second half of the year, as well as double-digit fee income growth, which will boost earnings. So that's for UOB. Now let's move on to OCBC. So for OCBC, their second quarter earnings were slightly above our estimates, and this was mainly due to higher non-interest income from fees, insurance, and trading income, as well as moderate growth in their net interest income, which was offset by higher expenses. Their first half PATMI was at 54% of our forecast, and their interim dividend was also up 10% year-on-year to 44 cents. Jumping straight to the positives, first positive was that their non-interest income continues to climb, and this growth was broad-based from their fee income, trading income, as well as their insurance income. Their total wealth management income now grew for first half of 2024, grew 14% and contributed to 35% of the group's total income. And their wealth management AUM was also 2% higher year-on-year, mainly driven by continued net new money inflows of 6 billion for the quarter. Second positive is that their net interest income inched up by 2% year-on-year, mainly from a 5% increase in their average assets, which was offset slightly by the NIM moderating by 6 basis points year-on-year to 2.2%. And this asset growth was from high-quality assets, which were income accretive, but lower yielding as compared to loans. So we can see them, I think, shifting the focus away from pushing their asset growth into loans, but now more into high-quality assets, which they can sort of earn interest on. For the third positive is that their allowances was down 43% year-on-year, and their credit costs as well has also improved to 15 basis points. This improvement was mainly due to a GP write-back of 10 million and offset by a rise in specific provisions to 154 million. And this uptick in the specific provisions was due to several accounts. It's more like a business as usual with no systemic risk as well as no concentration in any sector or geography. As for the negative, there's just one negative, which is the expenses has continued to rise, mainly from higher staff, IT related, as well as business promotion expenses. But nonetheless, if you look at their cost to income ratio, it has improved to 37.8% from 38.5% a year ago. For the outlook, their loans growth is single digit, so it only grew by 2% in second quarter, but this is still meeting their guidance of a low single digit for FY24. Management does expect some global growth to slow down in 2024, but Asia to outperform. So they have guided for this low single digit loans growth, and for the growth to be coming from the energy, power, and utility segments, as well as from, in their words, inflation-resistant segments such as purpose-built student accommodation, as well as hospitality. Fee income, we are positive on their fee income growth, and they have also recently launched a private banking unit in Malaysia as well as mainland China to strengthen its wealth management service, while also increasing the hiring for the business and increasing their relationship manager headcount. So they currently have about 400 plus RMs. They do intend to increase that further. And their recent acquisitions of the PT Bank Commonwealth Indonesia will also accelerate their growth in ASEAN. Therefore, we are expecting fee income growth of around 12% for FY24. Lastly, for their commercial real estate office sector loans, it's mostly to network customers in key markets with a proven track record and financial strength. So we feel that this sector exposure is contained, and most of this portfolio is secure with overall LTVs between 50 to 60%. And specifically, the CRE office sector loans only make up 11% of their total loan book, with 2/3 of the loans to key markets in Singapore, Malaysia, Indonesia, and Greater China. And notably for Hong Kong-wise, the Hong Kong CRE exposure makes up only less than 2% of total loans, with the LTV below 50% and mainly to their large network customers, which are more stable. We do maintain and accumulate with an unchanged target price of $15.40, and our FY24 estimates remain unchanged. We expect the FY24 earnings to grow from double-digit fee income recovery as well as stabilized provisions. The net interest income will remain flattish as stable loans growth from rate cuts expected in the second half of the year will be offset by moderating net interest margins. And we like OCBC due to their attractive valuations, the dividend yield of around 6.2% as well, buffered by a well-capitalized 15.5% CET1, and non-interest income growth from their recent acquisitions. So that's all I have for OCBC. I'll now hand it over to Miao. Thank you.
Thank you, Glenn. I'll go through Suntec result. Next slide, please. So results are mostly in line with our expectation. And something positive about Suntec is they have very robust rental reversion in FY24, achieving 20.8% for retail and 9.7% for office. F&B remains the best performing sector, and we expect more tenants from the leisure sector, such as F&B, to uphold rental reversion in the high teens for FY24. While office rental reversion are moderating, especially with the new supply from the IOI building. Suntec still experience a large portion of the new renewal list from ORQ and MBFC, which are the direct competitor to IOI. And Suntec Convention Center continues to be benefited from the influx of event-driven tourism, with revenue surging by 16.5% year-on-year. Although it only accounted for around 2% of the total income, but we believe the traffic can be easily redirected to other businesses, such as F&B in Suntec City, and its traffic improved by 6% year-on-year in first half 24. Yeah, and it already returned to pre-COVID levels. Thus, this will boost tenant sales. And for the negative, occupancy rate for the overseas asset remain weak. 55 Curry Street is currently below market rate at around 56.2%, and is expected to be improved to around 60% by third quarter 24. And the market remain weak despite the government effort of boosting the defense sector. The Minister building in London is expected to be fully backfilled by second half 24, with the revenue started to coming in around in FY25. So for outlook, we expect rental reversion in Singapore to hold up well, supported by the stable occupancy cost in retail and also high retention demand in office sector. And retail rental reversion is projected to sustain at the high teens for retail and low teens for office in FY24. And overseas asset continue to face pressure, especially with the elevated incentives and influx of supply in Australia. And Suntec has adjusted its leasing strategy by dividing units into smaller space to lower the barriers of entry. This has been proving effective. Meanwhile, the UK asset sees leasing momentum picking up, particularly as the new CBD office supply maintain on the downward trajectory. And Suntec is still committed to its divestment of strata units and target of 100 million this year. And other proceeds will be used to pay down the debt. So they have a target gearing of 40%. So despite the probability of lower ICR threshold from 2.5 times to 1.5 times by MAS, Suntec remain disciplined in terms of its leverage. And is currently trading at FY24 dividend yield of 5.6%, with an attractive valuation of 0.6 times price to NAV. And we reiterate our buy recommendation with unchanged DDM back target price of $1.41. Yeah, next slide, please. Yeah, we have our Far East Hospitality Trust. So, well, majority of the REITs are still having a negative DPU growth. Far East Hospitality Trust managed to deliver a 2.2% increase in their DPU, and it's around 47% of our FY24 DPU forecast. Something positive about Far East is their hotel occupancy rate improved by 2.1 percentage point to 80.4% in first half 24, as hotels gradually ramp up after exiting government contracts. And this is still, there is still an 8% shortfall compared to the pre-COVID level. So this indicates there's potential for further ADR growth. So further occupancy growth may come from higher visitors arrival in Singapore, currently at 84% of pre-COVID level. And forward booking for third quarter 24 remains healthy, with holiday coming up and also several events lines up, such as F1 in September. And we forecast RevPAR to grow at 6.1% year-on-year in FY24. And our cost of debt increased by 0.4 percentage point in in second quarter 24, as the fixed swaps gradually falls, but we expect the all-in cost of debt to maintain at the current level for the remaining FY 24. And other negative points, for the negatives, is ADR is tapering off. With very strong SGD and high base from FY 23, ADR is tapering off from second quarter 24. It decreased by 1.3% year-on-year. And leisure travelers currently accounted for more than 70% of the total hotel revenue. So recovery from several major markets, such as China and Japan, is still slower than expected, with booking at 80% and 60% of pre-COVID level, respectively. And for outlook, Far East Hospitality Trust observed more last-minute booking for the hotels due to more cautious spending by our customers. And different hotels are at different stages of recovery. For instance, Orchard Reservoirs is actively securing a high occupancy before marketing the ADR higher to capture the RevPAR upside. And they also observe gross operating profit is improving, especially for the Sentosa asset. GOP is already exceeded 50%, and they also has been generating positive cash flow after considering depreciation. And Far East may consider to acquire the remaining stake of this asset. They currently hold around 30% of the interest. And the REIT DPU will be at least on par with FY 23 level, despite normalizing room rates, since they have 24 million proceeds from the divestment of Central Square. So they plan to distribute around 8 million per year. And Far East Hospitality Trust is currently trading at FY 24 dividend yield of 6.5%, and we lower our DDM back target price from 0.79 to $0.75. Considering the fading recovery tailwind and also potential revenue headwinds from the macroeconomic uncertainties. And next slide, please. So we have Singapore Airlines. Next slide, please. So net profit for Singapore Airlines was below our estimation at 20% of our full year forecast, and passenger yield decreased by 4.6% year-on-year. Something positive about SIA is they had record first quarter group passenger load factor. SIA achieved a record first quarter load factor at 87.4%, and its revenue available per kilometer for first quarter 25 maintained at 117 of pre-COVID level, and achieved the record high, excluding the two exceptional years post-COVID. We believe the earnings has been normalizing in the face of the fading pent-up demand, and we pencil in 2% of the revenue growth for FY 25 as more capacity has been added. And some of the major markets has also been having isn't flat controls, such as Indonesia and also China, although capacity is still below pre-COVID level. And 4 more destinations has been added for SIA and Scoot compared to same time last year. And for negatives, they have increasing cost. The industry is not immune to the geopolitical and inflationary pressure. So in first quarter 25, expenditure increased by 14% year-on-year. And despite the higher volume contribute to increasing jet fuel cost, higher price and lower hedging gains suggest that the costs remain elevated, given the low cost hedges taken during COVID level has been expired. Meanwhile, other expenses creeping up as well, such as the ground handling charges and passenger costs, as SES just renewed its contract, so this increased by 7% year-on-year. And overall, we expect profit to decrease by 33% year-on-year in FY 25. And for outlook, SIA observed changing consumer preferences towards more last-minute booking, with with government. SIA operates 28 weekly service to Beijing, and with the weaker macroeconomic conditions and impose headwinds, this continue to impose headwinds on the outbound demand from China. And additionally, we expect further downtime and costs to occur for Scoot, as they currently has like prolonged repairment time for the 6 aircrafts. So despite SIA's effort to mitigate this by leasing additional aircraft, costs may continue to arise and add on pressures for the already very depressing yield. So we're maintaining our reduced call with a lower target price of $5.3. This is previously was $5.9, and this is at one-time FY25 price to book. Yeah, so that's all for SIA. Next slide, please. So Darren is on physical briefing, so I'll cover Darren for KDC. Yeah, next slide, please. So in first half 24, DPU was down 9.9% year-on-year due to the loss allowance for the doubtful receivable from Guangdong DC, which amounted to 10.5 million in first half 24. And for positives, high portfolio occupancy is maintained at 97.5%, and positive rental reversion was secured for the new and also renewal contracts. This was around 40% in Singapore, and 20.2% of the lease expired in second half 24. And we expect strong positive reversion for this list as well. And for the acquisition of the regarding Guangdong, for the question regarding Guangdong DC, rentals continue to be owned by the master lessee at Guangdong DC. And currently the tenant owns 11.5 months, and the rental totaling around 21 million. And this might also be a risk of the asset devaluation for Guangdong DC. If Keppel DC can't receive the remaining of the overdue rent. And the management is working on recovery plan with the tenant. And the impact on DPU at the Guangdong DC was around 0.6 cents for first half 24. And something positive on the acquisition. Yeah, and so on 11th of July, KDC and its sponsor Keppel, they announced to acquire 98% of the interest in the property of the name is called Tokyo DC Phase 1, if I remember correctly, at 2.5% discount to its valuation with an entry cap rate of 3%. And with the remaining lease of around 7 years, there is potential for positive rental reversion and growth due to increasing demand for generative AI and also tightened data center supply in Japan. Furthermore, there is the current rental is around 10% to 15% below the current market rate, and it was committed pretty much like 10 years ago. So the acquisition is expected to be completed in third quarter 24 and projected to have 1.1% accretive DPU growth. And so the borrowing is in JPY denominated debt. This is expected to lower the all-in cost of borrowing to 3.3%. And for outlook, the strong momentum of the investment into data center is expected to continue and fueled by the institutional investment and very strong underlying fundamentals. So we maintain a cumulative with higher DDM backed target price of $1.93. The current share implies FY24 to FY25 DPU yield of 4.7% and 5.1%. Yeah, next slide, please. So moving on to class, their portfolio RevPAR continue to improve despite the high base in FY23. And the second quarter 24 RevPAR grew by 4% year-on-year to 155, reaching 102% of the pre-COVID level. This is mainly due to higher ADR. And average portfolio occupancy was stable at 75%. So RevPAR for Class 5 key markets, Australia, Japan, Singapore, UK, and also the US, continue to match or exceed pre-COVID levels on the same store basis. And the Class acquired the remaining 10% stake in Standard and Columbia. This is a student accommodation, and using the proceeds from the divestment. So 408 million in the asset was divested across 10 mature assets at premium to its book value for the past year. This unlocked 44.6% of the gains, and with average exit yield of 3.8%. And for AEI was completed in first half 24 with another 4 properties under AEI, which is expected to be completed from second half 24 to FY 26. And this would increase Class distributable income. And for Class property in France, this is expected to be benefited from the Paris Olympic, and with room rate increased by more than 50% for the duration of the event. And Japan property should be continued benefited from the international travels demand due to the weak yen. And so we maintain our buy recommendation, and DDM back target price is unchanged at $1.04. Yeah, next slide, please. Yeah, so we have the last counter first rate. Next slide, please. Something positive about first rate is the rental at local currency term continue to grow. In first half 24, rental income from Indonesia and Singapore grew by 4.4% and 2% respectively, with income from Japan remaining stable. In first half 24, Siloam contributed more than 56% of the rental income from hospitals in Indonesia, and is expected to increase its contribution to over 80% after October 26. And rentals owned by the tenant MPU amounted to 6.4 million. And MPU is actively managed to secure and to pay its rental by attempting to make sizable property divestment to free up the liquidity, and also has requested some more time to make their payment. And first rate is also very optimistic that they can meet the obligations. For outlook, first rate remain focused on its 2.0 growth strategy with a target of develop the market to compress more than 50% of the portfolio by FY 27. And they continue to be benefited from the base of 4.5% escalation for Indonesia hospitals, which could potentially offset the impact of depreciating IDR against Singapore dollar. As such, we maintain our buy recommendation with a unchanged DDM back target price of $0.3. Yeah, that's all for me. I'll hand over to Ding for technical post. Thank you.
Thanks, Mel. Good morning, everyone. I'll move on to the technicals. First up, let's take a look at the S&P 500. What happened last week was that it did a retest of this breakdown of the uptrend channel. Over here, it found resistance, and following which on Friday, the price broke down the 5,400 support level over here. So with that, we are likely to see some further pullback ahead, with the next support zone at 5,190 to 5,260 area, and the immediate resistance at 5,400 to 5,460 area. Next up, we have our ETF money for July. We titled it US Treasury Bonds and Gold to Extend Gains. So first up, let's take a look at how the asset classes performed in July. All of them were in the green, less Hang Seng Index, which was down 2%. The top gainers were Bitcoin, which climbed 8%, and gold, which was up 5%. And in terms of their current trends, currently S&P 500, US Treasury Bonds, and Singapore equities are currently in an uptrend. oil, Bitcoin, and Hang Seng Index are in the downtrend, while gold is in the range consolidation. In terms of outlook for August, we view that US Treasury bonds and gold are expected to extend their gains, while S&P 500, oil, Bitcoin, and Singapore equities could pull back. And Hang Seng Index is expected to consolidate sideways in August. So first, I'll look at the S&P 500 ETF VOO. You can see that the price in late July, that we broke down this uptrend support line over here, and with bearish divergence and bearish crossover on the MACD. So with that, we could see price do a further pullback towards a retest of the this previous resistance level here around $475. Then next, I'll look at the Treasury Bond ETF IEF. It's looking positive. There was a carrying on. There was a continuation of the bullish momentum since breaking out this downtrend channel over here, with price breaking above $96 over here. So we could still see continuation of the momentum upwards to test this swing high over here at close to $99.65. Then next, I'll look at the gold ETF GLDM. It's currently still in the range consolidation, but overall still looking positive, with higher lows being created along the way, with resistance still holding out at $48.20 area. So it could still move higher to retest this trendline resistance to hit about the next resistance area about $51. Next up for the oil and gas ETF XOP, some bearish signs. Price tried to break above the downtrend channel resistance. Try to break over the downtrend channel resistance over here, but then met resistance at the $151 area over here. And then subsequently, there was a breakdown below the support level. So with that, with the bearish momentum, we could see the price extend the fall towards the next support zone at around $127, $128 over here in August. Then for the Bitcoin ETF, BITO, there was a rebound in July from the uptrend support line and a confluence of the downtrend channel support. But then it continued to form a lower high and lower low trend in the downtrend channel. With the current bearish momentum, we expect to see this ETF continue its downtrend and possibly retest the recent swing lows around the $18 level. Then looking at Singapore equities ETF, ES3, it has performed quite well in July, but and then in the second half of the month, there was a bit of a pullback going on. So with that, we think that we could see the pullback continue to retest this consolidation area around $3.37 to about $3.43 before price does a rebound. And then last but not least, for the Hang Seng Index ETF 2828, there was a brief bounce from the uptrend channel support in July before a breakdown in the second half. So with the current bearish momentum, price is expected to retest this prior consolidation area, which is about around the 60 Hong Kong dollar level. So we could potentially find some support over here for a bounce. And then next, I'll look at the Thai SDR monthly for July. We titled it Kasikorn Bank, Advanced Info Service, and Delta Electronics to extend their gains. So first out, looking at the performance in July, it was quite mixed. The top gainers were Gulf Energy, Advanced Info Service, and Delta Electronics, which was up between 11% to 22%. As for the losers, it was Airports of Thailand, which was down about 2%, and PTT, which was down 3%. In terms of the current trends, we see that Gulf Energy, Advanced Info Service, and Delta Electronics are currently in an uptrend, and Airports of Thailand, PTT, and Siam Cement are in downtrend, while CPO and Kasikorn Bank are in a range consolidation. And for our outlook for August, we think that these three top gainers for this month could extend their gains into August, while the Airports of Thailand, PTT, and Siam Cement could extend their weakness in the coming month. And for CPO and Gulf Energy, the price could actually trade sideways. So first, I'll look at the chart for Airports of Thailand. There was increasing bearish momentum. You can see that price over here. They try to bounce back above this support, this swing low support over here at about 57 but then continue to form a lower high and then price form a lower low. So with that, we still likely to see some bearish momentum ahead. And next up for CPO, price continue to hold a bearish flag support, but it has remained relatively sideways. With the recent swing high level around 60 baht level likely to act as some resistance. We could see price remain sort of sideways in the coming month. Then for PET, price is currently still bounded by the downtrend resistance line after breaking down a support level at about 150 baht level. With price recently hitting the $141 baht support level, we could see price do a bit of sideways. And then next up for Gulf Energy Development, price has been performing well, breaking above the range consolidation resistance as well as the downtrend resistance line. So it's currently nearing a retest of the downtrend channel resistance over here again. So we could still see some further upside to retest about the 49 to 50 baht level in the coming month before it could do a bit of a sideways consolidation. Then next up for Kasikorn Bank, price action has also been looking good. Since the breakout of the downtrend channel, it did a retest over here, found support, and then price is expected to actually continue to make a higher high over here, continuing on this recent trend. So we could see price go up to higher towards the 140 level. As for Siam Cement, price action continues to remain weak. Price continues to trade outside the downtrend channel, forming lower highs, lower lows. With the current bearish momentum, we expect to see price continue its weakness towards about at least 210 baht level, which was a swing low formed in March 2020. For Advanced Info Service, price action looking good. There was a breakout of the price continues momentum since breaking of this cup and handle formation over here, as well as the neckline resistance at 224 baht level. So we could see this momentum actually continue towards this trendline resistance, where price could hit about 241 to 247 area. And last but not least, for Delta Electronics, price has also remained strong. Since breaking out this downtrend channel over here, price has climbed above this swing high resistance at about 95 baht level. So we could still see price continue some upside towards this key resistance area about 115 baht area. Then next up for individual counters, we first up with a technical buy for McDonald's at $263.93. Take profit levels at $278 and $284, with a stop loss at $256. The last close was $276.69 on Friday. So for McDonald's, I think there's some reversal patterns showing. So first up, there was a breakout of a downtrend resistance line, confluent with a range consolidation breakout between $247 to $262, with bullish divergence and increasing momentum on the MACD indicator. So we could retest these two previous swing high resistance levels. And next up for China Aviation, with a technical buy stop at 90 cents. Take profit levels at 93.5 cents and 98.5 cents. Stop loss at 87.5 cents. Last close was 88 cents on Friday. So while this trade has not been initiated yet because price has not climbed above the 90 cents buy stop level, but currently in terms of the chart wise, it's consolidating in a bullish pattern with increasing momentum on MACD. So potentially, if there's a breakout, it will hit towards these two previous resistance levels. Yeah, and these are just a summary of the trades initiated. Currently, McDonald's is up about 4.8%. So that's all from me. I'll hand over time to Paul to talk about Raffles Medical Group results. Thanks.
Yeah, thanks. Thanks, Dean. So I'll just move on to Raffles Medical. So for us, the competition will keep the upside. We'll explain why in the next slide. So the results was generally in line with our expectations. The only positive we could find is that the revenue in China is starting to improve, or at least still grow. If you look at the very bottom of the table on the left, you can see China is 6%, but it's still very small. It's only like 10% of revenue. The negatives for us was, even though revenue was flat, you can see that the margins collapsed and net profit or adjusted net profit is down almost 50%. So the margin collapsed because they secured less government grants. The insurance, yeah, I mean, probably very few people know this, but Raffles is also involved in healthcare insurance. That is also losing money, and then they have losses in China, which is expected. And there's also weaker margins from transitional care facilities. They do not explicitly talk about this, but it's known that because the last bidding they did was probably like 20 or 60, 70% below the previous price. Or higher than the previous price when they were bidding for this. So transitional care facilities, you can think of it like temporary hospitals. So when public hospitals have too many patients, the government will just push some of these patients to these TCFs. And that, because of the intense bidding activity, the margins also lower. So in terms of outlook, we didn't change our profit, but we raised our revenue because the insurance business revenue surge, you can see from the left here, almost 28%. But in general, how we see Raffles Medical is that there's competitive pressure. So what's happening is that the insurers, the integrated shield plan, on top of our so-called MediShield, you pay a bit of premium, then you can go, I guess, better rooms. What is happening is that the insurers are actually moving the patients from public hospitals to private. So that will impact Raffles at the bottom, I guess. And then, of course, there's the usual foreign competition from Malaysia and Thailand that is also affecting some of their medical tourists. And then at the very high end, so the place to maneuver if you're a private hospital in Singapore is to go to the most complex and like a better word, the best margin cases. But that's also facing competition. So most of the major complex, although it's anecdotal, most of it actually goes to IHH or Parkway Gleneagles. So in a nutshell, I think Gleneagles Raffles is basically facing a squeeze at the top end and also at the bottom. And also foreign tourists are not coming in. So we think their earnings is just going to normalize back to pre-pandemic. Pre-pandemic, their profit was probably 60, 70 million. Until the China hospitals, the 3 China hospitals that they have can hit scale, then I think this stock will just be moving sideways in line with their earnings. But when can they hit scale? I can only guess. When can China hit scale? It's probably another 4 or 5 years, which is typical for any hospital to break even. That's the only guidance, which they don't really give, but that's the general guidance for greenfield hospitals. Next slide. I'll move on to Sheng Siong, next slide. So for Sheng Siong, our title was a new stores, so that's the main highlight for the results. Results were generally in line of virtually almost 50% of forecast. The positive is gross margins continue to be on the uptrend. So the gross margins now is 30.9. It continues to just slowly creep up. This time around, it was because there was more fresh food. So fresh food usually have better margins, as much as 40%. You're talking about meat, fruits, and so forth. The negative was the same store sales growth. They don't give the exact number. I think the way they compute now has changed and it's probably not relevant or useful. But when we do our own estimates, that means if you look at new stores that grew 3% but revenue only grew 1%, so we are assuming that the same store sales contracted around 2%. And then that's purely mainly because the whole industry is so weak in terms of supermarket sales. We didn't change our forecast, we didn't change our target. The highlight for us was the new stores. So just to give you some perspective, the last 12 months, that means June last year to June this year, they only grew 3 stores. But this calendar year alone, the first half, they grew 2 stores. There's 3 more coming up in second half 24. So they will virtually double this year. And then they are pending award by the HDB for another 3 stores. And on top of it, they are tendering another 7 more. So if you take 5, let's assume a 50% hit rate. They this year you're talking about probably 10 stores, some roll out to early next year. So they could double, triple the new stores. But this doesn't mean that growth for Sheng Siong going to hit like a double digit. So even with the new stores, we're talking maybe like high single digit kind of revenue growth. So it's just an acceleration from this like 1-2% that they're experiencing. Next slide. So I'll move on to Pan United. So decarbonizing, because they got this new product, which is a low carbon, which is very rare. How many building materials? Yeah, next slide. But generally, the earnings was within our expectations. The forecast profit is 44 because there's a seasonally usually slower in the first quarter, first half. So what drove the earnings? You notice the earnings is up 22%, although revenue is up 7%. Partly there was an improvement in gross margin slightly, but mainly because of operating leverage, because they managed to grow revenue, but their staff cost was flat or if not kind of decline. The negative was the higher capex. So there's a plan right now to move all the batching plants. So batching plants is where you collect all the cement, stone, aggregate, and you mix it for the ready mix concrete. So all these are going to move towards Tuas. So this will push up near term their capex from the usual 5-10 million to now 60 million over 2 years. So that's why their capex will be higher in the near term. So that's the only negative. But we maintain our forecast. Our target price raised a bit because the previous WACC that we used, which is the cost of equity, was a bit high. I think it was a bit too high, so 20%. So we just drop it down to more normalized or even still high 15%. So for us, for Pan United, is more of a macro story also, because we think compared to the previous cycle, there's more visibility and stability of construction contracts over the next 5 years. I think this is the similar macro story or trend that we talked about for BRC Asia, another steel materials supplier. So BCA, which is which their forecast is generally very accurate, but so their forecast is average for the next 5 years. That means every year you're looking at 34.5 billion of construction orders, mainly from the public sector. So this is 23% higher than pre-pandemic of 28 billion. So this gives visibility, and this is supposed to be up to 2028. So usually they don't give such a long forecast, and also this forecast now is much higher. And BCA will benefit because they have a more 40% market share in ready mix concrete. Yeah, next slide. So I'll move on to our usual weekly, a few macro. I won't run through everything, but for Thailand, we do track the industry sales, and the beer and liquor sales continue to be strong. So you're up 14-15%. So if you take, because the numbers are up to June, so the June quarter, the sales for beer is about 12, versus first quarter was only up 5%. So you can see that alcohol sales is starting to accelerate. The data from the US, it was all over the news. Payrolls only 114,000, and it's actually below expectations. The one that caught the most attention was the unemployment rate, because it is highest in 33 months, and actually is even higher than pre-pandemic. Before we entered the pandemic in 2019, the unemployment rate in the US was 3.6. So now it's even higher than the pre-pandemic. Then of course PMI, then there was even more bad economic new numbers, like the PMI was down. PMI is like a survey of manufacturing, whether it's growing or not. So it's contracting of 47 below 50. Then durable goods, this is a way to gauge how much the corporates are spending on equipment, machinery, and so forth. So this is the biggest contraction in 4 years. So a lot of negative data that's also affected the US markets. Next slide. So for tactical views, I think interest rate cut in September is almost a done deal. I think in the recent FOMC meeting, his comments, I think this was the only thing to listen. I know it was probably 1 hour, but he just said that a reduction in interest rates or policy rate is on the table. And he was referring to September. This was on 31st July. Then on Friday, it came out the disappointing payroll. So the expectations of rate cut went to 3. Then by Friday, it went to 4 times rate cut. So in general, all this will be positive for REITs. You won't see it in the DPU, but you can't wait until DPU actually goes up, then you go into REITs, and it's a bit too late. But for REITs, you will benefit because interest rates are lower interest expenses. Then because when rates are down, their DPU can grow organically as interest rates start to come down. Higher valuations because the cap rate come down, then the values of the assets go up, and they become an attractive alternative because bond yields will be coming down, and if REIT dividend yields remain the same, then it will, on a relative basis, it becomes more attractive to buy a REIT. But any aggressive interest rate cut by the Fed is going to be negative for Singapore banks because it will pressure on interest margins. The other worry we have is there's a looming provisioning cycle in Hong Kong. So if you look at Hang Seng Bank, which is owned by HSBC, their NPL provisioning is actually at a 25-year high. So this is the highest. So we worry there's a bad debt cycle coming in Hong Kong, and then of course this is going to affect the Singapore banks. On the tech sector, I won't go through too much of this. There's all this debate of whether all the AI spending will generate sufficient returns. But I think Google probably just give you a sense of where they see this. Whether are they buying all these AI GPUs speculatively or for competitive reasons. I think for them is that the risk of underinvesting is worse than overinvesting. So they will continue to spend on these GPUs. And I think if you're a competitor like Amazon or Facebook, you will look at this and you will also try to outbid them. But we're not saying it's rational to buy all these GPUs, but it means that there is a big race now for, I guess, the race for AGI. But the thing to worry about the return on all these so-called ChatGPT or generative AI is made worse because Meta is giving away their so-called ChatGPT equivalent for free. So what it means is that generative AI, the marginal cost of generative AI could go to zero, because how you compete with free, right? Since Meta is giving it away for free. But in general, we still think it's going to be positive for NVIDIA's supply chain. Although in the near term, all these stocks are being sold down because there's a big unwind of all these NVIDIA AI-related names. I think it's pretty obvious from the weakness we saw on Friday. So in terms of events to watch out for, we will have Sembcorp Industries results. We got DBS results on the 7th, is during lunchtime, and then we have SGX. We have a lot of events. I guess the one in green are the larger companies. We even have VinFast. If you want to know more about a Vietnam car maker trying to enter EV, and dial in for that. And of course, we have Comfort. Next slide. It's open for everyone, the webinars. So the chart on the left, just to show the Hang Seng Bank, this is the NPL ratio to total loans. You can see the big spike to 5% in the most recent results that they made. So it's a 25-year high if you want to do a count. So the one on the right is just to show the rebound in alcohol consumption. Next slide. On the left is just to show that it's still weak on manufacturing activity. But for it to hit recession levels, you're talking probably has to go to 40 or even 30. The shaded one is recession. Yeah. This one just to show contraction in corporate spending. Next slide. The one on the left, okay, ignore the December 25, might confuse everyone, but the one where the futures market is pricing is the December 24. So the blue line was where the market was expecting interest rates to be by December. They were thinking of 3.8. Then, of course, all the REITs sold off and it went to, by July, it was 4.6. Then recently in August, I think on Friday, it really gapped another 50 basis points. So when the bad employment number came down, expectations went from 3 cuts to, or maybe 2.5 to 4 cuts right now. So labor conditions are actually, you can see it's sliding. I mean, the unemployment rate is 4.3. Pre-pandemic was 3.5 or 3.6. Then, yeah, next slide. If we go, okay, we go through our usual model portfolio. The only one that was negative was Conrail, minus 0.7. The rest were all gains, and of course, Singtel was up. But we still underperformed because of the rally in the banks, and 3.5. The SING means we cannot say STI because they will charge us money. So we're using the SING ETF, which is up 3.5. Next slide. Probably almost of the gains already wiped out, but then this just to give you some of the sectors that did well. So what did well? All the REITs did well. Virtually all sectors did well except conglomerates. The one on the left, it showed you that the top 10 gainers was actually all the US REITs were the one that did exceptionally well. And some of the marine-related stocks are like Dynamax, Seatrium. The bottom are more the index gainers and losers, just for your reference. Next slide. This is by asset. So what did, finally, I think the REITs outperform most of the asset classes. Outperform commodities, bonds, US. The US market Nasdaq was down 1%. Probably going to be more in August. And worst performer was commodities. So these are all ETFs and so forth. Yeah, next slide. Finally, this is just how did Singapore market compare with the Asian market. So the worst performer last month was Taiwan. I think all the tech stocks and China-related stocks all affected. The best performer in the region, I mean in local currency at least, is well, some of the REITs and some of the mid-cap names in Singapore. Next slide. Okay, just on my last one, because we always get a lot of questions on Seatrium. So for Seatrium, just go straight to it. The revenue was strong. The one at the top is the actual results. So if you focus on underlying net profit, 115 million. So it looks strong, I mean, that they are turning around. But if you look at the very bottom, the comment, their net profit, I mean, they don't really give, in a way, they also don't really strip out all these gains, although they call it underlying. If you take out the gain on sale and their legal costs, they hardly make any profit. They're probably talking about 10 or 15 million profit. So that's why the earnings slowed down. If you go back to the financials part, you can see the gross margins was only 5% because they have versus their mid-teen targets. So the stock slowed down, not only just the whole market was weak, but because the results was pretty disappointing. Especially you make 4 billion revenue, you can't even make any profit. So they're still burdened with a lot of costs, and the main one was mainly because they got a lot of legacy contracts. So some of them included some of the old contracts they secured at very low margins. So the earnings should turn around once they build the new FPSOs. Just one last comment is that you'll notice their order books is 26 billion. This is like a decade high. Most of it came from because of the Petrobras orders and the 3 HDVCs. So these are basically, when you build an offshore wind farm, you need, although you generate all this power, you need something to convert all this high voltage power to something that can move offshore. So these are mainly all the offshore winds. They convert the power back to onshore that can take on all this power. I forgot, is it AC or DC? Sorry, I totally forgot. Yeah. So anyway, we can move on to our Q&A. Yeah, thanks.
Yeah.
Oh,
Glenn, go ahead.
Go ahead. Okay, yeah. It's quite a few banking questions. I think to be expected. Okay, I'll just be quick as we don't have much time. Okay, first one, what's the outlook on next steps on GE and OCBC? So there's in the news already, and they also mentioned it, that the GE shareholders can still sell their shares at the offer price of $25.60 to OCBC until the 23rd of October 2024. However, SGX has also come out to say that GE needs to restore their free float. I think they give them I think it's 3 months. Yeah, 3 months to do it. So back to 10%, right? But I'm not sure if that's the line that's the way the path that they'll be going towards, at least for both G and OCBC, because it really contradicts whatever OCBC is trying to do, right? If they buy in so much at $25.60 and then they have to restore the free float back. Yeah, so I think it's more of like just an extension to allow them to see what they can do until that deadline which they have. Yeah, so really just have to watch and see what OCBC or GE comes up with next. Yeah, it's really hard to predict. Nobody knows. Next one, I think there's a few bank one. Hold on, let me try to find. Okay, hi Glenn. WB, I'm guessing is Warren Buffett, dumping Bank of America stocks. Does he think outlook not good? That's quite surprising that he's doing that, but we do have a neutral, right, for Bank of America. And I think what Warren Buffett is doing might be taking in some profit, right? Maybe he feels that he has too much into the Bank of America specifically. So for Bank of America, we feel that for Bank of America, their earnings will improve in the second half of the year and overall, at least for the full year, mainly from higher net interest income, because they did mention some fixed asset repricing that will benefit their net interest income, as well as their continued growth in the investment banking and wealth management fees due to higher capital markets activity. But however, they also have quite a few headwinds, which is the lackluster loans growth they are facing. Actually, not just them, most of the banks are facing that, and higher provisioning from their credit card as well as their commercial real estate offices. Yeah, so I don't think the outlook is not good specifically per se for Bank of America, but it might be some kind of like profit taking or maybe diversifying into other sectors and not just the banking sector. Is market pricing in lower NIM and net interest income for SG banks after the US yields crash? I think the market has already sort of priced that in, but then again, the Singapore banks, they are a lot more stable in the sense for their net interest income as well as their margins, because majority of their loans, right, are not in fixed rates. So banks, they have two different ways of giving out loans. They can do a fixed rate loan, or they can do a sort of floating rate loan, right? So it's pegged to the SORA. So if the SORA moves up and down, interest rates go down, they still earn that spread, right, from their loans. And most of their loans are in that floating yield, right? So they don't really get affected as much. However, and also one interesting thing about Singapore banks is that they are quite cautious, right? Even all the banks, the most aggressive one being DBS, all three banks are very cautious and very prudent. So what they will do is that they like to put their assets into longer tenor, sort of interest yielding sort of securities and assets. So this will be able to let them predict in longer term, in maybe the next short to medium term, like 2 years and above, how their net interest margins will be like. We have seen OCBC do that, and they have mentioned how they are managing, shifting away some of their assets from the loan side, but into longer tenor securities, interest yielding assets, basically. Yeah, so I think it's already priced in really for the Singapore banks. Sorry, moving on next. What's your outlook for Singapore banks for the rest of 2024 with impending interest cuts? Any negative impact on NIM? I just spoke about this. Yeah, so for the rest of the outlook, we feel that the fee and wealth management income will continue to grow. The AUM and then their base has actually seen quite good improvement. And not just that, even though their base is improving, the margins they're earning are also improving, mainly due to the improved market sentiments as well as the higher market activity. And investor sentiment is also shifting away from like lower yielding, lower margins sort of products like their fixed Ds. It's now shifting into higher margin products like investment products, wealth management products. So that is what's causing the big jump in their fee income, right, for all the banks. So we have seen that, and I think that will be one of the bigger growth drivers for the banks. Any negative impact on the NIM? Yeah, I think NIM will still take a hit, right? It definitely won't be rosy, and like we're looking at like double-digit basis point increase. But if they manage to improve their funding costs, which is what UOB has done because they have cut their one account interest rates, then they will be able to manage their NIM. So we will see it maybe drop a few basis points, but it will be relatively stable as to what it is now. So I don't think there will be a very big impact on the NIM. But for net interest income, I don't think we'll see growth as well. It will be very stable. The other things will be propping it up, like the loans growth. We could see a larger improvement in loans growth for the second half of the year, at least for the rest of the 2024. But the main one will be the fee income that we giving that growth driver for their earnings. Okay, hi, is the market telling us to switch out of the banking sector based on the steep drop in share price today, as the Fed is expected to cut rate aggressively in the second half of 2024? It might be a bit of like profit taking, because the banks, I guess, have reached like all-time highs, right? All three of them. So it might be a bit of a profit taking, but if you look at the dividend yield and the way that the banks sort of do their business, and I just mentioned, right, the whole how the banks are looking like in the second half of the year, it's relatively stable. But of course, the growth won't be as fast as it was a year ago. So that might be one of the reasons, right? People want fast growth. Maybe they're not looking for stable, like 6% dividend yield. They want like very fast. So I'm not sure if there's a bit of a shift to other sectors, maybe the REITs. I think Darren can talk more about that later. So I think that's one of the main reasons. But it's for the banks, you're just really buying into that stability. We have seen their dividend yield being stable. At least for DBS, they are still continuing to increase their dividends. Hopefully, we will see some good news on Wednesday, yeah, for DBS. Okay, one more. Hi, Glenn. In recession, can loan growth offset interest income drop so the share price can sustain? I think in a recession, I don't think anything can sort of offset the interest income drop. We have seen it previously in the past few recessions, right? The banks will suffer, not just the banks, but every other sector will do quite badly, at least in Singapore. So if you're talking about rate cuts, when the rate cuts, can loan growth offset interest income drop? I don't think it will be able to fully offset the interest income drop, because it also depends on the appetite of the customers that they have and how aggressive they are pushing to get loans. But the banks have seen to be pushing harder for loans, because with the rates, I think when the rates eventually do get cut, we could see the loans improving quite a bit. And hopefully whatever that the banks have placed in place, right, to sort of maintain and to protect their NIM, it does kick in and does protect their NIM. Then we could see that the loans growth will offset some of the interest income drop. But I don't think it will really fully offset that drop. And we could see maybe low single digit sort of decline in the interest income, but it is still much better than if there is no sort of like loans growth to offset it. Yeah, basically. Like I mentioned earlier again, right? Like the bank is made up of so many segments and sectors, so the other departments will have to step up to ensure that their earnings and their share price and their dividend yield can be sustained. I think I do have a few more. Let me go through quickly. Okay, what's your expectation of DBS second quarter results, especially on the net interest margins and net interest income, similar to OCBC UOB? Yeah, so in the previous quarter, in the first quarter, DBS's NIM and net interest income was the only one that grew year on year, right? And I think that's the benefit that they have, being the largest bank in Singapore, and also their dividend yields also. Sorry, nothing about dividend yield, but yeah, their results were surprisingly good. And also, if you look at their fee income grew a lot faster, a lot higher than the other two banks, mainly due to their AUM being the biggest, and they are also quite aggressive in pushing out a lot of their products. So I think their net interest margins, net interest income will be quite similar to the other two banks. We could see low single digit increase in net interest income, and their margins, I think, will be sustained. Probably will not see any increase in their net interest margins. It will probably be flat if you're looking at a quarter-on-quarter sort of a basis. And for the rest, fee income will still be growing quite healthily. I think the one surprise that we could come in would be the loans growth, how much their loans have grown, whether they can surpass their peers. Their peers have shown, like a bit of an improvement, low single digit kind of loans growth. If DBS can sort of surpass that, then I think they will be growing faster than the other two banks, basically. Yeah. And also, yeah, the biggest surprise, of course, will be their dividends. The other two have said 50-51% payout ratio. If DBS goes true to their word and they continue to increase dividends, that will be the differentiator compared to the other two banks. Okay, I think someone asked for the UOB slide. Yeah, it's up now. I think that is all for me. Yes. Okay, I will hand it over to the rest of my colleagues. Thank you. Yeah, maybe over to you, John. Thanks.
Yeah, thanks again. I'll just take a few semi-con questions if we have time. So as a first question here for AMD, there's a couple of questions on AMD. First one is, for AMD, the valuation looks overvalued, and for the trailing PE is 150 times. Yes. Another question here is, AMD share price has been dropping for the past 6 months since reaching a high of 200 in March. Any insight why this is so? Okay, so I guess the simplest answer is that the valuations are getting quite stretched. I mean, if you look at price of AMD over the course of a year, is just like a rocket ship going up. And then you throw in some of a bit of weakness in terms of the overall commentary on China tariffs, and a little bit of concern over ROI for AI and AI spending. And actually, you see a little bit of weakness there. But when you look at current valuations now, trading at less than 40 times forward PE, but earnings for this year are expected to triple and at least double for next year. So if you look at it from that 1-2 year standpoint, it does still look fairly undervalued. And we just think that the overall sell-off it's no different from in the last 3 weeks. I think it's sold off close to 30%, 25%, similar to all the other major semicon companies like ASML, AMD, and basically all, even NVIDIA also, I think down to like 20+%. So likely due to a little bit of rotation out of semicons, a bit about out of tech due to their valuations. But in terms of fundamentals, nothing really too significant has changed. Yeah, so that leads me to my other question here. There's one on NVIDIA. NVIDIA chip being delayed. Is there any sorry, let me find it. Is there going to be any impact to NVIDIA or AMD and so on? Yeah, so likely would this create a big shock to the next 7 capex as their capex is on? So actually, from this standpoint, it likely will actually benefit capex for a lot of the big tech companies because most of this is like ordered in advance and it's only recognized upon delivery. So for example, if your Blackwells are not going to be delivered in the fourth quarter and moved into the first quarter of next year, what you likely see is a little bit of a decline in terms of capex for the year. On the flip side, NVIDIA has always maintained that Blackwell was not going to impact overall revenue growth that significantly for this year. So what that means is that they probably start delivering only late in the fourth quarter. And so if they delay into next year, likely won't have that significant impact on revenue for this year. Probably will be beneficial for next year. In terms of will that help AMD? Maybe to a small extent, but likely not really that significant because, like I said, most of these chips are ordered way in advance, so there's really customer commitments there. On the flip side, AMD also has a lot of supply issues as well. They're not able to acquire as much supply as they get versus NVIDIA, right? So there's still a lot of at least supply power and pricing power for NVIDIA. So hope that helps. I'll hand it back to the rest of my colleagues for now. Thank you.
I guess I'll answer the Apple question. So there are multiple questions asking whether the outlook is bad, why people are selling Apple. If you look at the shares fundamentally, actually they did really great. So financially, it's pretty sound. It's a beat across the board. That means they're not just beating estimate in revenue in EPS, they're also beating the estimate in every single product category. The only miss they had is the China market. So China market decreased 6% year on year. But they said part of it was due to the foreign exchange. So if you deduce that, the decrease was about 3% year on year. So that claim by Apple is still considered a pretty great improvement compared to their first half of the year. But the numbers are definitely not that great. Usually it's a fun fact that every time they bring up that China market is not doing really good, they will usually comment that it's not really about the iPhone, it's actually the other product category that didn't do well. But this time they didn't say so. So that kind of implies that Apple is actually one of the reasons, or in fact one of the major reasons that they're not doing well. So they're definitely still facing a lot of domestic competition from the local brands. And they recently started offering discounts, so that kind of hurts their revenue as well. The other reason that people are actually selling is because once they announced the Apple Intelligence, there was actually a lot of hype waiting for the super cycles to start, because Apple Intelligence, you can only use it for iPhone 15 Pro and Pro Max. So we're kind of expecting that super cycle to come. And since Apple Intelligence is going to get rolled out in Q4, so a lot of people is actually waiting to see whether the demand is going to start piking up in Q4. But according to their guidance, it's not likely. Right now, this quarter, the iPhone was dropped 1% year on year, which is already considered pretty good compared to their past quarter performance. And their guidance for the next quarter is 5% for the entire revenue growth. They didn't really specifically mention a different product, but if you just do simple math, their service revenue was around 20% year on year. Their iPad this year was 2 digits, this quarter was 2 digits as well. So probably going to be positive. So if we just do simple math, probably their iPhone for the next quarter is going to be muted, or it might even do worse. But with that being said, that means if you're expecting the super cycle to come right away in 2024, that's probably unlikely to happen. But it's definitely still going to happen in 2025. And the super cycle doesn't really start until they actually fully roll out the Apple Intelligence. And from then, we actually really do expect seeing the super cycle coming. So I guess it's really about timing. So fundamentally, nothing wrong with Apple. I hope that answers your question. I'll pass my time to other colleagues.
Darren, you want to take on some of the REIT, then we hand it over to Zane.
Yeah, I need to find the questions, but I was typing in the Manulife, but I'll rather just talk because there's quite a bit. So for Manulife, there's a question on what was the please enlighten on Manulife results. Yeah, so for Manulife, their first half results, basically they had negative reversion of 10.6%, and the occupancy for their portfolio is only at 78% because they had a few known vacates at the start of the year, and they're still trying to lease up the space there. But the main thing for them is to progress on with the disposition mandate. So for the disposition mandate, the update is they put 3 assets in the market and 1 off the market, and they've seen some decent interest in those markets in these 3 assets. But the sense that I got was that the bidders or the buyers, they couldn't really match the price that Manulife they were trying to sell. So it's taking some time. So it's still a challenging market as the funding is still quite limited from the local banks. Yeah, so it's still quite challenging to dispose. Yeah, and they have to meet the target. If not, they have to pay a small penalty by end of this year, and by the middle of next year. Yeah, so that to fulfill the recapitalization plan. So that is yeah, the update, and we hope to hear get more updates as soon as they manage to have some divestments aid as soon as possible, because they're on a timer after all. They have to do so to bring their gearing to below 50%. As now their gearing is still at 56%. Yeah, so that's just a quick update. But some positives are that the leasing momentum, they noted that they have a lot of viewings at their properties for leasing, but the lock-in rate, like a lot of people view, but not a lot of people, the sign-ups were not, the actual sign-ups were not very high as compared to the viewings. Yeah, but at least there is some interest in the property, so that can be seen as a plus. Okay, yeah, there's one. A rate cut mean REIT sector outperform or down with the rest if recession. Yeah, so generally rate cuts, it will mean that the REIT sector will benefit because of a few reasons. I think Paul mentioned in his slides earlier, but I'll just repeat. Is basically one of it is valuations will likely to improve because the cap rate will compress from the interest rate cuts. So that's one. And they also will benefit from the immediate lower interest rates, lower interest expense. So that will then immediately benefit the distributable income as they just minus off lesser interest expense. And with lower interest rates also, the transactions volume will likely to recover, like the asset dispositions and asset recycling, because funding will be cheaper, and there are likely to be more buyers as well. And one more is that the yield spread will be higher as well, as probably when the interest rates come down, the 10-year bond yield will fall as well, in line as we've seen the recent movements in the yield market or the treasury market in the US. Yeah, so that will help to bring the dividend yield spread higher as well. So that is a sector outperform, and or down with the rest if recession. Yeah, so if recession hits, REITs will also be affected. Basically, they will be hit by the top line, and maybe some of the tenants also, like one unfortunate example is the Keppel DC REIT, the Guangdong data center tenant, they couldn't pay. So if recession hits, then we might see some of this non-collection of rental income as well. So definitely REITs will be affected if recession hits. Yeah, I think I'll hand on to my colleagues for now. Thanks.
Yeah, yeah, okay. I'll just do one very quick one, then we'll hand it over. So I'm trying to type in most of the questions. So before I hand it over to Zim for technical, so what's your expectation in Sembcorp results tomorrow? We don't expect it to be strong. if you recall, they mentioned in the previous briefing that they have 2 plants under scheduled maintenance. So that could hit them, their earnings by almost 60 million. So, but it was really well flagged out. But again, people could still sell it down, but don't expect strong results for Sembcorp. Is Keppel results good or bad, please? And I'm still doing the note from Chef Yan. So, and in general, the results was below expectations. I think you can, of our annualized numbers, I think you can calculate it quite easy. It's not giving any forward thing, but the one that's dragged is property and so forth. So for us, our view on Keppel is mainly on them selling some of their assets. I think operationally, we are not expecting anything strong from them. Because their focus now is to build fund management, and this is going to take some time for it to really move the earnings. And if they're relying on land sales in Vietnam or China, I think that's also going to be delayed. I don't think there's going to get any attractive prices in China. So it's more disposal gains that we're looking at for Keppel, rather than operational strength. So the annualized earnings was below our expectations. Okay, all these are text questions which we'll handle. I think your take on gold for the rest of the year. The funny thing is gold virtually nothing to do with fundamental. It's just basically on China, on central bank continue buying. So we still think there could be some run left because of the geopolitics. But after that, I think like we showed in our ETF briefing, or even in our gold as a percentage of world GDP, you're talking about 16 trillion, 17 trillion. As a percentage of world GDP, I mean, one way to value it is as high as during the 1970s. If you recall, 1970s, gold went from, I don't know, $30 to $100, if I'm not mistaken, or more, or $300. I can't remember how many times, but gold, the value of gold to world GDP is as high as that right now. Yeah. But they could be, I think my guess is there still could be some more, a little bit left in the move, because of the way the geopolitics, and also with interest rates falling, usually that benefits gold. Again, it's my guess. Yeah. Because there's no way to value gold it's all dependent on flows. What's the odds of recession next year? 40%. I'm just joking. I will use 40-50% so that I will never be wrong. So if there isn't any, then I told you 60% is not. So, but the point is not so much whether there's a recession, but the point is that things are slowing down. So like we type in the commentary, a lot of questions on this SAM rule. So the key thing right now is that things are slowing down. It's pretty evident in labor market, everything. And interest rates are going to be cut. So right now you see this market sell-off, we think it's a big unwinding of all the previous position. The previous position was short bonds because growth is slow, because US is going to have a soft landing, and so that is really all taken. I think people are unwinding all this. Yeah, so that's why you're going to see this big unwinding of growth and soft landing and so forth. So that's how the market is positioning. I think, of course, it's pretty obvious that that's happening, but this is just to give some context to it. What's your update on UOMA and Thomson Medical? I'll take on this last one before I hand it to Zain. UOMA, nothing much. UOMA is really more just, it's almost like looking at newspaper headlines because all geopolitics. So nothing much to comment. The transition of the chairman has already been done, and they will have been already preparing this for even before this event. Because I mean, it's only natural because of the chairman's age and so forth. Thomson Medical, we think earnings, like Raffles Medical won't be like spectacular, but the whole story for Thomson Medical is the hidden value of their Johor land. I think we'll get more updates once they release the results. I'll hand it over to you, Zain. So it's a bit shorter for you to.
Thanks, Paul. Okay, I'll just share my screen right now for the TA. Okay, so first question is on the 3 local banks. Okay, so first up, looking at DBS, today open with a gap down over here below this previous resistance level at 34.30. So with that, currently selling momentum still looking very strong with increasing volume as well. With that, I think we still could see price heading lower with the momentum coming off currently into oversold region for the RSI. So I think we could see maybe price perhaps touch this, retest this 3240 previous range consolidation level over here. Yeah. Then we see whether there's some bullish, there could be some bullish candle start to appear, then we could see some bounce afterwards. Yeah, but for now it's just the sell still continuing for now. Then for UOB, also quite similar, we open in the gap down below this prior resistance at $30.90. So with that, I think we still could see some downside, perhaps towards the next support area over here, which is around 2970. Yeah. OCBC, currently it's a retest of this uptrend support line over here. Also below this prior range resistance level of $14.50. Currently it hit the first level of support at $14.10. So need to see whether this holds. If not, we could see another pullback towards the next support area over here, closer to $13.70, $13.80 region. Yeah. The next one is on Sembcorp Industries. Okay, for Sembcorp Industries, I think there was a breakdown below this range consolidation of 460 to 480. Today actually retested a previous swing low around 445. Found some support coming in, so hopefully it stays this way. Then we could see some bounce coming in, but likelihood is that still resistance currently between 475 to about 485 region. Given the downtrend it has been. The next one for Seatrium. Okay, Seatrium currently it's still there was a heavy volume selling last Friday, breaking below this gap area of 151 at prior range resistance area. Today, price is open around this range support at 145. Currently we see a lower wick, so if it closes this way, we could see some small bounce ahead. But likelihood is still resistance around 150 to 152 area for the time being. Yeah. The next one is on Ascott. So for CLAS, it has been consolidating in the range currently, but it has been unable to break above the 89 cents level. So currently seeing some weakness today. Important thing is that the support over here at 86.5 cents must hold for this range to continue. If not, we could see some further pullback towards the next support level around 84.5 cents for CLAS. Okay, the next one I'll talk about AEM. Okay, for AEM, generally still continuing its downtrend over here since breaking down this 180 level over here. Looking at a longer term chart, we are currently near a potential support level over here. If you look at this trend line support over here where price did a bounce previously. So around here at maybe 140, we could potentially see some bounce coming in if it holds as a support. Then next up is CLI, CapitaLand Investment. Okay, CapitaLand Investment, I think for not looking very good because previously there was a false breakout above 274 over here, and then subsequently price did a retest, couldn't get above again. And then today we are seeing price gapping down below this uptrend support line over here. So that quite a few signs of weakness currently taking place. I think we could see some potential price weakness towards the next support area over here, closer to about 250s over here for CLI. Then for sets, Okay, for sets, I think some weakness today. There was I couldn't hold this swing low support at 315. Also recently from a lower high over here. So I think for now we likely to see some pullback taking place. Currently below the 5, 10, 20 moving day averages as well. So I think we could see some further pullback towards a retest of this prior resistance area around 295 to about 298 over here. Okay, there's a question, what's your view on US tech stocks now to sell with? Okay, I'll use the NASDAQ as a reference. So looking at NASDAQ wise, currently we are actually quite there was a quite huge drawdown from peak. Is about 11%. Previously looking at the previous corrections, the one in July to October last year was about 13%. This year in April, the short pullback was about 8%. So I think over here, it's about the usual correction drawdown levels, about 13%, 15% over there. So I think for now, and then today there's also probably another gap down taking place. I think for now, it's probably too late to sell, I guess. Over here there's some previous supports over here. I think the 16.3K, 16.4K level, as well as the close to 16K level. So I think for now, I think it could be better to wait out. Yeah, since the drawdown is actually quite huge from the peak. And yeah, I'll answer more of the Singapore questions since there's some comments about. Then I'll answer the US ones probably tonight during the TA session. The next one is it's about SGX. The SGX, I think over here it's still holding on quite well. It's probably range trading currently between about 965 to about 980s. So I think as long as this range support is not broken, I think overall still looking okay since the trend is still upwards for now. Then next up for SIA. Okay, SIA has been still carrying on the bearish momentum. I think we could see potentially some support coming in around these swing lows at around 587 over here for some pounds if it holds as a support. Then currently resistance probably is around $6 to about 615 area. Then next one is on MLT and MIT. So for MLT, I think it's currently still in a bit of a range consolidation. Price is currently still unable to get back above this 132, 133 level over here, which was a prior support, and he broke down afterwards. So likelihood is that I think it's probably consolidating in a lower range between 127 to about 132 currently. Then for MIT, it's Mapletree Industrial Trust. I think it's also currently still in a bit of a consolidation. Price it retested this prior resistance around $2.30, and then there was a pullback taking place. So likelihood is still quite range consolidation with support at this previous resistance area of about 220 to about 222 over here. Okay, then next one I'll talk about iFast, Steep, and Stack. Okay, for iFast, I think today we've seen a breakdown of an ascending triangle pattern. Okay, let me just highlight it. Yeah, over here, breaking down this uptrend support line over here with a gap down. So I think likelihood is that price could hit over towards this next support area over here, which is between about 650s to about 675 over here. . next one for Power Steep. I think over here still nothing too much. It's just in the range consolidation between around 99 cents to about $1.05 area. So as long as this support level over here is still holding, I think it's still continuing on in this range for now. Okay, then for Aztec. Okay, Aztec, I think has been probably a false breakout over here. After the results, there was a gap up above $1.04. However, it met resistance at the previous $1.07 area with this engulfing pattern over here. Then price momentum subsequently came down. Currently, we're at one support level, which was this swing low, and then this range consolidation resistance previously at 98 cents. Yeah. So and then next level is probably around at 96 cents level, which is this range support as well as this trend line. So over here, I think probably limited downside over here. Yeah, if the price holds as a support over here, we could see some bounce ahead with resistance currently at $1 to about $1.02 area. Yeah, sorry, I'm unable to take the other questions in view of time, but feel free to post. Thank you for your questions. Feel free to post them in our Volume 3 TA community, then I'll take it over then. Yeah, I'll hand over time back to Paul to close the session. Thanks.
Yeah, thanks everyone. I'll just answer this last one because I couldn't type it out. Why the weakness in the ringgit? Yeah, I'm also disappointed when I went JB. It used to be 3.6, now it's 3.33. But okay, but the reason why the ringgit is strong is also if I'm referring to compared to the Singapore, is mainly because of the Sing dollar is very closely linked to the US dollar. I mean, our monetary policy interest rates virtually mimic the US. So right now, Bank Negara is not looking to cut rates, and then compared to the US, going to cut rates quite aggressively. So that's one of the main reasons. It's just this interest rate differential, and when this happens, I think that's not to repeat myself, but investors tend to unwind their positions. So that's why we think that's why the ringgit has strengthened. Against Sing dollar, it's not like year to date, it hasn't really strengthened like at 4 or 5%. Just that probably for the year to date, it's probably above the Sing dollar, probably 1% or so. Yeah, just that when we went JB, it was 360. Now it's not. Now it's 3.33. Yeah. Okay. Thanks everyone for your time. Sorry we can't take, because there are almost like 70, 80 questions. Sorry we couldn't take all the questions, but if you post it, we'll try our best to answer as many as we can. Thanks everyone. I wish everyone to have a good week ahead, and thank you for your questions and for your time. Thank you, everybody.